Brad Williams, Frugal Finance. Here's just a quick, brief discussion on institutional investors and smart money. Well, traditionally, you have professional money managers, and they've always been identified as the smart money versus retail investors, who are generally the suckers out there. Well, I've been doing this for close to 50 years, believe it or not. And I truly believe that there is a difference between institutional investors, smart money, versus retail investors. Retail investors usually just listen to the crap on social media or television, and then they just buy, and they don't do much in terms of the research. Whereas the institutional investors, that's their job. They don't work 40 hours a week doing this. They're doing probably 100-hour weeks. That's the demand, because they get paid on performance. You, as the retail investor, get paid on sometimes hope, sometimes luck, and sometimes huge losses. So that being said, retail investors, also referred to as individual investors, use their money to buy and sell securities and other investment products for themselves. Institutional investors, on the other hand, are professional investors who pull together capital, sometimes referred to as Wall Street smart money, and invest on behalf of others, typically at much higher volumes than retail investors. Now, let me point this out. Here's the biggest thing that retail investors have to deal with. And I've faced this over and over again because I used to day trade. And the problem is you have these mutual funds or these portfolio managers. They can move the market, okay? They can control the market. They can control stock. So if they want to push the stock down 3% in a blink, it doesn't take them more than just a couple keystrokes, and they'll do it. And then they'll turn around and reverse. Jane Street Capital does this all the time. So does a lot of the other hedge funds. They're using a lot of different tools you, as a retail investor, don't have privilege to. They have the money. They have the professionals in there, literally. They're in a bullpen, and half of them, they're bullish, and half are short in the same room with the same stock, but using different strategies. So you as a retail investor, you can try and see over a 3-year period whether you're still in business, trying to trade against the house. And I call this the house. These groups that are controlling the ETFs and the mutual funds, the hedge funds, the leverage groups, the derivatives. Do you stand a chance? Not in the long run. The only way you're going to stand a chance, in my opinion, is taking a long-term approach, all right? Buy high-quality companies with great management, and you just continue to diversify with at least 15 stocks, up to 25, and just do dollar cost averaging. These professional investors include pension funds, mutual funds, hedge funds, banks, insurance companies, endowment funds, and other big investors. Institutional investors account for large and frequent trades on behalf of organizations they represent, and institutional accounts for a significant percentage of stock trading volume. 90% now, I think it's 90% of all trades are done electronically. In other words, they're using black boxes, they're using algorithms. You're betting against something that you can't trade that fast. That's the deal. If you try to manage more than one or two positions, you can't move that fast. And literally in a hot, fast market, unless you have a trading platform where all you have to do is hit a button that says buy, 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 and then it says sell, 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 sell. And I'm sure there are day traders that have that capability. But otherwise, you are going to get hung up going through a Schwab or a Robinhood, because you have to put that information in, and I want to buy 100 shares or I want to buy 100 options, whereas the professionals, they just hit a single button or they pre-program it. The rise of institutional investors has been fueled in recent decades by the growing number of Americans who have invested in professionally managed pooled investment products such as mutual funds and ETFs. Smart money isn't always smarter. Clearly, you're going to find companies that blow up. These institutional investors that think they're smarter than everyone else, maybe they've had a good run for 10 years and they blow up. It happens all the time, okay? Because, bulls make money, bears make money, but pigs get slaughtered. You're going to hear that all the time. Well, you're going to find that greed gets in the way of rigorous management style, and you start taking shortcuts when you start making a lot of money, thinking I can do this over and over and over again. And next thing you know, you blow up. You start making so much money, you get an inflow of new money, then you just can't manage that. And one thing leads to another. You're going to run into this domino effect. You can do a little history there. You can read about some of the biggest companies in the world that blew up because of their greed and arrogance. Due to their deep resources, they can generally conduct sophisticated research and analysis of companies and markets. And they might have dedicated teams making specialized decisions. But just because institutional investors have more resources doesn't mean they'll always make the right call. Even the most advanced financial modeling can sometimes miss negative trends or fail to spot the emergence of disruptive technology. Not every institutional investor can outperform the market, so blindly following the smart money can potentially leave you facing losses. Understanding institutional holdings, researching companies on FINRA's market data site or other financial websites can help you identify the biggest shareholders. You can also learn about institutional holdings by reviewing SEC commission filings. Institutions that manage over $100 million worth of securities are required to file Form 13F within 45 days of the end of the quarter. Now, no one reads this, but some people do, believe it or not. That's why the institutional investors have huge staffs. Literally, they hire people and they read all this SEC data because it could be one simple nugget in a footnote buried so deep, maybe in a Form 13F, that someone read and they go, wow, this looks like a nugget. And then no one else follows and they take the position, and guess what? That separates those with the competitive advantage and those that don't. This information can help individual investors track institutional holdings over time. Keep in mind, though, that the lag time means what you see in the filings may be outdated by the time you're able to assess the information. Institutions that acquire beneficial ownership of more than 5% of a covered class of company stock are required to file a 13D with the SEC within 5 business days after crossing that threshold. If there's any material change in ownership, a prompt amendment is required. Now, there are some individuals out there that want to skirt this, and the SEC, I think they need to be more diligent on this. Depending upon the facts and circumstances, institutions might instead be eligible to file the shorter Schedule 13G. This form can be filed as soon as 5 business days after passing the 5% threshold, or as late as 45 days after the end of the calendar quarter in which the threshold was crossed, depending on the type of investor. Now, if you are looking at acquiring the company and you look at filing late, well, the SEC is going to scold you. Individual investors can use the SEC Edgar database to see the names of institutional investors, so on and so forth. Choosing your investments. Some individual investors prefer to invest in companies with a high concentration of institutional ownership, considering this is an important standard among others in choosing stocks. How many people mirror everything about Warren Buffett in terms of Warren Buffett's stock selection? Others aim to get in on the ground floor with their investments, finding stocks with limited institutional investments to avoid the impact of a herd mentality. Be aware that institutional investors with large stakes in the company could weigh heavily in shareholder voting, including proxy votes on the makeup of the board of directors and corporate actions. Alternatively, if one institution starts selling large blocks of stocks, this could prompt other investors to sell as well, which might lead to significant volatility. I've stated this in other videos. Check it out. Just the overall impact of market cap, for example. I have a video on that, and I talk about the impact of the herd mentality. Institutional investors are sophisticated investment professionals, and learning about their ownership can be a good way to research a company. But institutional ownership, or a lack thereof, is no guarantee that a stock or a company will perform well. If you're a retail investor, research all aspects of a company before investing, not just the level of interest in the stock shown by institutional investors. So as I keep saying, find quality companies, find quality management, find something that you know. Buy stocks, buy companies that you know something about. Comment. Let me know. Let me know your experiences. Let me know if you agree with this. Let me know if you just shoot from the hip, that you've been lucky, you've made a lot of money, you're an options trader, you've been day trading. been bullish the last 4 years. You've made a gazillion dollars. Share your experiences or your losses. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.